Good evening, ladies and gentlemen. As a representative from Thammasat University, it is our pleasure to present to you our analysis on Dynasty Ceramic Public Company Limited, or DCC. And despite an attractive dividend yield and high return on equity, we placed the sell recommendation with a target price of 4.54 baht, or a downside of 20%. And this will be supported by three reasons. First, the company's limited growth opportunity. It is currently overvalued by the market. And lastly, there are several concerns on stock liquidity and the succession of the business. But before we continue, let me take you through DCC's business model. Dynasty Ceramic is Thailand's largest tile manufacturer. The company is a family-run business with over 42% stake owned by Thammasat family. Targets low to middle income customer segments, mainly in provincial areas. The company distributes products mainly through its own outlet store, which represent over 67% of sales. And by engaging in both manufacturing and retailing business, DCC has been able to establish a strong cost leadership position, as we can see from the highest gross margin and ROE as compared to local peers. In addition, they also have a large distribution network of 195 outlet stores located nationwide. These two factors has historically helped DCC lengthen its leading position in Thailand's tile market. And up to this point, DCC may sound like a good company to you, but with our thorough analysis, my colleague will be telling you why DCC may not be a good investment for you.
Looking forward, the company might not be able to enjoy a stellar growth like it did in the past. Currently, there are four main factors that limit the company's future. First, the limited store expansion. With 195 outlet stores already covered 92% of all provinces in Thailand, DCC will face a difficulty in further expanding its store, which reflects in the declining in number of new stores opened, as well as the management failure to achieve its target expansion over the past year. And with this trend continue, we expect the number of new stores open to continue declining throughout the forecast period. And with this limited ability to drive growth through store expansion, the company will need to rely more on same-store sales. And for same-store sales, since 98% of DCC revenue is coming from the provincial area, its performance is closely tied to the upcountry demand. And by analyzing this upcountry demand, it still be limited by two factors. First, the deteriorating agricultural prices due to the oversupply of agricultural products globally. Since over 40% of Thai labor are in agricultural areas and most of them live outside Bangkok, the drop of farm income indicates the weakened purchasing power of DCC main customer. And moreover, with an all-time high household debt of 84% of total GDP, it will further delay the spending on home renovation products since it is a discretionary good. And with these two constraints, the recovery of same-store sales growth after the unstable political situation last year is expected to be slow.
And in addition, after we've done the cash flow analysis, we found out that usually the company uses cash for the maintenance of the capex and for the improvement of the current existing business. And together with the fact that the company has continued paying out 100% dividend for 4 consecutive years since 2010, and also the passive style of management that has no intention for international expansion, this signals an absence of the future growth driver. And apart from internal, the company also faces an intensifying competition. Despite the moderate growth of the local tiles with 10%, the industry can observe a significant increase of imports with 28% compound annual growth rate. And looking back to DCC, the company only grew by 6%. And the reason behind the success of the imports are their competitive advantages of the cheaper labor costs, lower natural gas price, and also high production scale. These allow them to sell at 10 to 15% lower than the local tiles. And due to our analysis and forecast, DCC market share could continue decreasing from 25% in 2011 to 15% in 2019. And this clearly indicates that DCC cost leadership will no longer be its competitive advantage. And not only imports that drives the competition, but also the emerging of the home improvement retailers. In the past, DCC was the only one who focused on low to middle income segment, but currently, there are 3 home improvement retailers come into play, namely Thai Vasadu, Global House, and Mega Home. They are serving the same target customers with a greater variety of products in a larger store. And on top of that, they They also had a very aggressive store expansion to almost double in the past 2 years. And this expected to continue in such a way that DCC outlet sales to be affected the most. And due to this fact, the company no longer enjoyed the position that it did in the past. Thus, the recovery of sales growth from 2014 and in the long run will be captured by the conservative management and also intensifying competition threatening the company. And by combining all four factors of the limit store expansion, pressure same-store sales, and absence of growth engine, and also intensifying competition, I also suppose that the future growth of DCC is limited.
With these limitations in growth story of the stock, DCC price is currently overvalued, and we expect the target price of 4.54 baht per share, which is derived from two valuation methods: the free cash flow to firm and dividend discount model, to reflect the controlling aspect of the management and the market holding intention as a dividend stock. The models consist of two main components. First is the free cash flow, which we expect the decline in sales growth due to the slow demand recovery and intensifying competition, while profit margins are improved, resulted from the decline natural gas price. And the cash flows are discounted by 9.5% cost of equity and the WACC of 9%. And the second component, which accounts for the largest part of the model, is the terminal value. The terminal growth rate comes from the target retention ratio of 5%, which is the level that allows DCC to maintain its capital structure, and the target ROE, which is derived from the DuPont analysis, using industry average profit margin to reflect the margin of the company in the long run. And in addition to our main valuation, we also consider the market view on the stock. If we look at the price to earning ratio of DCC, it's in line with the average of local and regional peers. However, when taking into account the growth aspect, the high PEG ratio of 6.7 indicates that the market over-expects the growth of the company. Furthermore, despite the high ROE of 46%, market has already assigned high premium on DCC, as you can see from the very high price to book value. And apart from our fundamental analysis, we also consider the potential upside risks prioritized by impact and probability. And there are two main risks that we would like to emphasize on. First is the operational risk from the decline in natural gas price. Since it contributes up to 30% of production costs, the further decrease in gas price would increase our target price. And after conducting the stress test, in order to change our recommendation from sell to buy, the natural gas price need to further decline by almost 50%. And second, the risk from the change in terminal growth rate, which is driven by terminal dividend payout ratio and return on equity. However, after we sensitize these two variables, most of the results still support the sale. Therefore, with the unjustified growth rate assigned by the market, high price to book value, and confirmative valuation, it is clear that DCC is overpriced.
Now, let's take a look at the key concerns on investability. DCC has very low liquidity comparing to the market average, particularly the deep drop in turnover last year, as you can see from this chart, led to the delisting from Z100 index or Thailand's blue chip stock index and can aggravate the implementation shortfall, especially for the large institutional investors. And following the recent stock split on January this year, we observed a significant price movement of DCC. This signals to us that the market gives little interest to DCC. And for the succession issue, not only being tightly held by Sangsatra family, but the family members are also the key management of the company, especially Mr. Rungrod, who is the major shareholder of the company. And with 15 years of experience in this business, he is responsible for many positions. However, this implies that the company has high reliance on him. However, he is now 65 years old and become more conservative, as can be observed from first, the slower growth of opening new stores. Second, the company is not taking advantage of expanding business overseas, especially in the ASEAN countries. And third, the 100% dividend payout for the past 4 years. And since currently the company is in the transition stage from the first to the second generation who have less experience, this could pose a succession risk to DCC, whether the second generation could maintain the company's leading position. Thus, with the low liquidity that could add the risk that lead to the potential implementation shortfall and the succession issue that could add the risk to the company's future, DCC may not be a good choice for your investment.
Because strong past performance doesn't guarantee favorable future prospect. With these three supporting reasons,